people tuning in from around the world. And you know what? It doesn't matter where you're from. It doesn't matter if you're from the Ukraine, if you're from Moscow, if you're from Kilimanjaro, if you're from Mumbai, if you're from New Jersey next door. Typically, what I attract are individuals that like technical analysis, that love reading candlesticks, that love to measure the action by figuring out chart patterns, by putting together a plan and a process that it doesn't matter if you speak Chinese, Japanese, Russian, Ukrainian, English, French, it doesn't matter. What you see is what you see to your upper right. Okay, what you do is you see a chart. And what we do is we measure the action of charts, we make decisions, and we incorporate it in our process. So this way we could figure out how to do our trades, how to incorporate our strategies, and how to make money so we can provide for our families. Is when you start trading, you're a different breed, okay? You're not guaranteed a salary, you're not guaranteed a pension, you're not guaranteed health insurance, you're not guaranteed anything, okay? The only thing you're given is a set of computer screens, a learning process for you to evolve in that could turn into one of the best situations you've ever been involved in, where you control your own destiny. You know, when the pandemic hit, it was definitely, it was a very scary time. January, February, I'm sure everyone was feeling the same. You know, all of a sudden you had China close their borders. You had Italy that was having their vacation time. All of a sudden everybody was skiing there. They had, you know, they had spikes in cases. In February, every single body out there was like, holy shit, this is gonna, did I just say holy shit? Holy shit, this could be worse than the financial crisis. This could be worse than the tech bubble bursting. This is different, okay? Things are getting shut during the financial crisis. It's not like they shut down the world for weeks, months. Nobody, absolutely nobody knew what was next. Nobody. I don't care who was on the TV set, even me. Nobody knew what would happen this year. So when you don't know what's going to happen, what do? You fall back on your process. What's my process? I use moving averages. What do moving averages tell me? Moving averages tell me the active strength of the market, whether there's momentum, whether we're weak, whether we're really weak, whether we're like we better friggin' avoid, or whether or not we could approach the market in a portfolio approach. Okay, that is why we use moving averages, because when all else fails and you have no idea what's next, the market will tell you what's next, not the talking heads on TV, not even me. The technicals will tell you. People from the age of 35 to 50 to 60 were reaching out to me, like, because they knew that I've been in the market. Okay, I've been in the market literally, like you guys said, since 1998, 2000. I traded through the tech bubble burst and the financial crisis. I had a lot of smart friends. I had a lot of smart friends who thought they knew what was going to happen and they projected what was going to happen. They didn't want to care about anything else. And then I had people who tried to just figure out what was next. So I think I told the story once where my wife was at UMD&J. Okay, in 2004 she started there. So she started with her 401k, and all of a sudden 2007 hit, and she kept putting money in the entire way down. 2007, all the way down to 2008, 88, all the way up to 2009, 99, and then all of a sudden we took off to where we are now. The financial crisis helped our average cost. My friend Mitch, who I explain all the time, he, you know, had his kids 529, started in 2004. His kids weren't going to college till 2011. Same thing. You know, aberrations and crashes in the market long term help your average cost, because over the next 100 years, long term, the bull market does win. And the market and the prognosticators out there, they're not going to tell you that they're going to tell you all the reasons why you shouldn't be in the market. They're not going to give you all the reasons why you should have a plan to stay in the market. So anyway, my wife's 401k was built during the financial crisis. My friends' college tuitions were built because of it. And then I had a very smart friend who said, I see this coming. And again, I was on CNBC during 2007, 2008, and I called the financial crisis very, very well. And as an active trader who traded for, I don't know if any of you guys saw it, that was different. Okay, but my friend sold the market. He's like, I'm so smart. I saw this whole thing coming. He sold his long-term accounts, got out of the way, and all of a sudden, boom, he sold S&P 1200. We went down to S&P 66, and here we are at S&P 3700, and he never bought back. How did he do? He was smart for about a year. I was like, okay, I'm doubling up on my son's 529, and I'm putting some cash account to work, and I'm staying with my 401k. So long term, I'm like, just stay the course. If you're 77 years old, it's different. If you're Ken who's 80 and you need your money. But anyway, all right, what does an RDR do? It gives you a signal that there could potentially be a trend change. Well, it could be just a day trade, or it could be a day and a half trade, right? So from 35.49 in the S&P all the way down to 32.59. How many handles is that? That's like 300 handles, right, Red Puppy? 300 handles down. This is your first signal that maybe the downside move is over, that this active sequence to the downside might have expired. Maybe we switch gears from risk off to risk back on. All of a sudden, you have your first move up, gap above the 21 day. This is 34.05. 34.05 is where finally we're above the 21 day. Did you catch the bottom? No, but 34.05 breaking the descending trend line. Is that a spot to switch gears? A spot to say, hey, I'm ready to go? Perhaps. This was November 4th, right? November 4th. What's today? December 23rd. How many days is that? I calculated that today. For 49 days, which is 7 weeks, the S&P has been above the 21 day, and it's probably only been below the 8 day 4 times. Is that a strong market or a weak market? Come on, Ricky. Rick Freeman knows it. It's a strong market. In a strong market, do you look to be short, or do you look to have multiple positions on to ride the trend? Anybody? Trend is strong. Portfolio approach. By the way, my portfolio approach used to be 4 to 12 positions, and now it's 18 to 24 to 35 positions because I am evolving, and you will also. With time, your portfolio approach might be 2 positions to 5 positions. It might turn into 20 to 25 positions. I've been doing this for 22 years. People on the virtual trading floor that left back 5 years ago that all of a sudden came back because maybe they were out of work, and maybe they wanted to revisit the market because it was moving, like, holy shit, Red Dog, you have 20 positions on. I've never seen you with 20 positions on. I'm like, well, Red Dog doesn't shine shoes no more. Okay. What movie was that? Anybody? Anyway, I'm like, I've evolved. There you go, Casino. No, Goodfellas, right? We evolved. I'm like, I used to have 12 positions, and I used to get, upset, and I used to get stressed out. And now, this Monday, right? What happened on Monday? The futures are down 70, 80 handles, right? I think I had 30 positions on them. And somebody on Twitter was like, you're an idiot for having that many positions on them. I'm like, why am I an idiot? The market looked just fine. Anyway, it's a process. That was a crazy scene, right? So anyway, here's the Red Dog reversal. Here's the gap above the moving averages. So on Monday, what did we do? We tested 36.36, and all of a sudden tested the prior pivot high, held it, and now here we are in this inside range, below 37.26, above 36.36, going sideways with a lot of nice individual stock action. Lots of it. Okay. Move to the side a little bit. Here we go. So now this is $25, right? That's where the stock is, $25. One down day goes to 21. Woo, $4 down. Next day goes down again, goes below 21, goes to 18. 25 to 18. Goes down again to 15. You guys see that? So you got 21, 18, now you're at 15. Let's see how smart you guys are. How many dollars is that down from 25? 10 points. So if you were out of the way, and all of a sudden the stock goes from 25 to 15, is it a little oversold? That's a bad stock. Not if you're short. It's a little oversold. A little bit. Okay. In order to go to 10, what does it have to get below first? Anybody? This is a really hard question. Really hard. No. What do you know? 15. 15 is the important pivot. That is all you know. What do we also call 15 for all of you versed in technical analysis, Red Dog language? 15 is your point of reference. 25, 21, 18, 15. There are some guys who are saying, hey, this friggin' stock's going out of business. It's going to 5. It's going to 10. Okay, it's down to 3 days. The strategic trader, like all of us that tune into the 630 Club, the Dog Pound, Redler All Access, the virtual trading, feel like, oh, we're 3 down days. We're looking for some type of Red Dog reversal scenario. So $15 is the rubber match spot. That is the battle between the bulls and the bears. Those who think it's going to 10 and those who think it's going to bounce. So all of a sudden, this opens up here at 16, right? It's up $1. Trades below 15, goes to just say 14. Can you see that? Okay. And now all of a sudden, comes up to 14.5. Now we're at 14.5. And then that morning, the futures go down, or the SPY drop another point, and it stays at 14.50. What just happened? Anybody? Where are my friends out there in technical analysis land? All of a sudden, 14 was the low. Futures continue to go. Relative strength, relative strength, relative strength, relative strength. Cheers to relative strength. That's how Red Dog makes a living, identifying relative strength. And then you combine it with a tactic, and that's how you make a living, and that's how you make cash flow, and that is how you pay your bills. So now, people who pressed it through 15, which we don't do, we don't usually buy 3 up days. We don't usually short 3 down days. That's our day count rule. We're not going to get into day count rules today. Now all of a sudden it goes to 15, goes to 14. The Dow is down 150 points. It bounces to 1450. As it bounces to 1450, the Dow is now down 300 points, and it stops going down. You guys all say, holy shit, relative strength. This just dropped from 25 to 15, 10 points. I am going to buy it here at 1450 versus 14. What's your risk? You're buying 1450 versus 14. What's your risk? 50 cents. 50 cents. $10. 50 cents. That's it. And then the next thing, now you're in tier 1. Remember the tier system, right? Tier system, you're buying right here. Then all of a sudden, you see the market start to bottom. You see the stock start to go up. It trades above 15. Gets through 15. What are you doing? Tier 2, you're adding to your position. The market just gave you a signal that it showed relative strength. It stopped going down. You bought tier 1 versus low. Now you're adding tier 3 through 15. And then all of a sudden, it goes up and it closes at just say 17. So you bought 1450, you bought 15, it closes at 17. You bought 2,000 shares at 1450, another 2,000 shares at 15. At 17, what you don't do is you don't take home all 4,000 shares. Maybe you sell 1,500, you book money and net money. We always talk about netting money, netting money, netting money. Everyone say netting money. I want to hear you say netting money. Everybody, net money. Red Pup said it. Net money. How do you put together a week, a month, a year? You net money. I don't care how much you love it. Okay? So now it closed at 17. You made on this, you're in 2,000 shares. You bought another 2,000 shares. It's now at 17. You sell 1,500 shares. Maybe you take home 2,500 shares. The next day it opens at 18 in the morning. The gap is in your favor because you're getting upside follow through. you sell another 1,000 shares, and then, excuse me, or another 1,500 shares. Now you're left with 1,000 trailer, and then you see maybe, it retraces back to here. But you bought it at 14.50 versus 14. You risked 50 cents. You added tier 2 through 15, went to 17. You took money off. You had some follow through, and that is the Red Dog reversal. That's it.